Hey, welcome back to the Divorce Mortgage Planning Minute, where we take a deeper dive into one aspect around divorce mortgage planning over the next minute or two. So today we are going to talk about how paying child support and paying spousal support or alimony is going to impact mortgage financing. One concept to understand before we really get started, and that's the concept of the debt-to-income ratio. The debt-to-income ratio is the minimum monthly payments of the items that appear on your credit report plus the proposed new mortgage payment with taxes and insurance, whether it's a purchase or a refinance, and that's divided by your gross monthly income, so your income before taxes. We, in the mortgage world, really like to see a debt-to-income ratio below 45, ideally below 43, but for our purposes, we are going to use 45%. So, paying support, paying alimony, those are all installment debts that need to be factored into mortgage lending. So, they're going to be counted as a liability unless they have 10 months or less remaining. If that's the case and we have 5 months left, 6, 7, or 8 months left, then we can remove that in most instances from qualifying. So you're paying support, you're paying alimony. It's a big monthly expense. It's really going to impact how much you can qualify for a mortgage. One guideline within mortgage lending will allow you to remove the spousal support or alimony portion from the liabilities and reduce it from income instead, which is going to help your debt to income ratio. And we're going to do that math right now. So in our first example, we make $10,000 a month in income. We pay $1,000 in child support, $1,000 in alimony, and we have $1,000 in car payment, credit card, and student loan combined. So 45% of $10,000 is $4,500. We then begin deducting these expenses. The $1,000 on the credit report takes us down to $3,500. The $1,000 in child support takes us down to $2,500. And the $1,000 in alimony or spousal support takes us down to $1,500 to qualify you for a mortgage. That's counting the spousal support or alimony as a liability. If we remove it from the liabilities and deduct it from income, here's how the math looks. So instead of having $10,000, we now have $9,000 to qualify you. 45% of $9,000 is $4,050. Then we deduct expenses. We have the $1,000 from the credit report, so now we're down to $3,050. We no longer have the alimony or spousal support, but we do have the child support, so we subtract the child support of $1,000, and now we're down to $2,050 to qualify you for a mortgage. So here's where you can see the benefit of deducting the alimony or spousal support from the income is much better for qualifying purposes than counting it as a liability. I hope this all makes sense. Thanks for watching. Like and subscribe if you really like the content. Stay awesome and stay tuned.